In lesson 4, we'll talk about a very important part of most, an overwhelming majority of commercial real estate investment purchases, and that is the loan, debt and debt service, and talk a little bit about how the loan can significantly impact the return that the investor receives, as well as different decisions that must be made, typically by the lender, as to whether they want to give a loan, what terms would that be, and how much of a loan they would be willing to give. So let's jump in. So in our cash flows, we talked about rent minus operating expenses equals that all-important number, net operating income. Well, net operating income is the amount of money available to pay the loan. And when we talk about the loan, in this context, when we're talking about annual cash flows, we'll talk about annual debt service. And as I've described in previous lessons, annual debt service is very simply just the monthly principal and interest payment on the loan, nothing else, just the loan payment times 12. So the monthly payment times 12, that's the annual amount paid to service the debt. And what's left over from the net operating income after paying annual debt service is our cash flow before tax, which is also a very important number that we will address a little bit later. So the loan amount can be a function of what the lender is willing to give, and loan to value or debt service coverage ratio. It also could be an investor preference. So an investor that is financially strong and could potentially get a loan, maximize the loan amount, or the amount of leverage is the word that we'll see, on a particular property or a particular purchase, might prefer instead to get a smaller loan, a more conservative approach. A smaller loan means a smaller annual debt service, means more cash flow. And of course, that requires a bigger equity down payment. But to an investor who has the capability to make a larger down payment, then getting a smaller loan is a less risky alternative. And so it could be any number of factors, and we'll talk about the other factors here in just a couple of minutes in this lesson. So something we're all familiar with would be loan to value, maybe less familiar with some of the other methods used, or the other primary method used, debt service coverage ratio, which I'll talk about in a minute. But if you hear the word leverage, borrowing money to purchase an investment is called leverage. So we are leveraging our investment, whatever that investment is going to be. For instance, for example, we're purchasing $1 million property, but we're getting an $800,000 loan. So our investment is actually $200,000. But we're leveraging that investment, we're leveraging that $200,000 by getting a loan of $800,000, 4 times the amount of our initial investment, and that actually is called the leverage ratio. Something we don't typically, a term we don't often hear, but that's what that represents. Something we're likely all very familiar with is loan to value. If you've ever purchased a house or worked with someone purchasing a house, very often the lender will quote loan amount in terms of a loan to value ratio. And that's just the relationship of the size of the loan to the value of the property. However, we can flip that around, and a lender can quote a loan to value ratio, which we can then apply to the value to calculate the amount of the loan. So a couple of different ways we can use loan to value ratio. Example number 1 here on the screen. We have a $480,000 loan, and the value of the property is $640,000. So the loan divided by the value is 0.80, or 80% loan to value. The way we can use loan to value, maybe quoted by a lender, to calculate a loan amount is here in example 2. We have a $675,000 value, and the lender says, I'll give you a 65% loan, 65% loan to value. And so we can calculate the amount of the loan. 675,000 times 0.65 equals $438,750. Now, if you want to try a couple of calculations yourself, I've got 2 sample problems down here. The first one where there's a $1,350,000 loan on a property that has a $1,800,000 value. What is the loan to value ratio? And the second question is a property with a value of $1,275,000 and the lender is quoting a 70% loan. So what would that loan amount be? So if you want to calculate that yourself, and I'll show the answers in a moment, just pause this recording, do the calculation, and then let's check your answers. Okay, the answer for the first problem is 75%. So the 1,350,000 divided by 1,008,000 is 75% loan to value. And in the second question, our 1,275,000 value and the lender's quoting a 70% loan results in a loan of $892,500. So fairly simple and fairly straightforward. Now, some other loan characteristics that we're going to be discussing in a little bit more detail here. The loan amount is often dictated by the lender, again, sometimes by the investor. I'm only looking to put 50% down. I only want a 50% or a 60% loan to value. Could be the lender's willing to give more, or as often as not, and in my experience, it's the amount is usually dictated by the lender, but it's based on a number of different factors. Certainly based on the market conditions for money, being the interest rates and what have you, but also in evaluating and underwriting the loan, and we'll talk in more detail about underwriting on the next slides. The lender will look at the borrower's experience, their credit worthiness, what other forms of security do they have. They'll certainly evaluate the property. Lenders have different preferences as well. Some lenders are more comfortable lending on one category of property as opposed to another. And over time, they gain more and more experience with that particular type of property. I've already mentioned the loan amount being loan to value versus debt service coverage ratio. And what debt service coverage ratio is, again, and I explained this a little bit in a previous lesson, and that is a way of calculating a maximum loan amount based on the lender's requirement that the annual debt service that the investor has to pay is such that it does not eat up too much of the net operating income. So we would think lenders are in the business of lending money. Why wouldn't they want to quote a loan or provide a loan, assuming the borrower is creditworthy? Why wouldn't they want to provide a loan that utilizes all of the net operating income if that is in fact, that income is there and capable of paying the loan? Well, there's a risk factor, and the lender wants to make sure that there is a cushion, if you will, between the amount that the investor has to pay on the loan, annual debt service, and the net operating income. So the lender wants that net operating income to be greater than the annual debt service to account for unforeseen events, unforeseen costs, maybe a tenant goes bankrupt and moves out, and also provide incentive for the investor to continue investing by providing the investor with a profit. And so the lender, based on the margin that they're looking for, that difference between the NOI and the annual debt service, might quote something like a debt service coverage ratio of 1.2. Well, what in the world does a 1.2 debt service coverage ratio mean? Well, a 1.2 debt service coverage ratio means that the NOI must be at least 120% of the annual debt service. Now, there's a calculation that we can use by taking the debt service coverage ratio and the NOI, calculating the maximum annual debt service, and then utilizing the other terms that the lender is quoting, the interest rate, the amortization period, etc., back into the loan amount. And that's going to be a topic for the next commercial investment course, where we'll dig deeper into commercial investment course, and we'll dig deeper into the commercial investment analysis. And a lot of this, or this evaluation in general, is referred to as underwriting, loan underwriting by the lender. So, what's involved in underwriting? Well, really, it all boils down to risk. The lender looks at the property, looks at the lender, looks at the market, and says, what's the probability that the property and the borrower will be able to make the debt service payments as agreed on over the entire term of this loan? The lender, I assure you, does not want to receive back through foreclosure ownership of the property. They're in the money lending business. They're not in the property owning and operating business. Now, that might not be true for some private sector lenders who are hoping that the borrower defaults, but our typical commercial lenders do not want to receive the property back. And so it's all about risk analysis. That is what underwriting is about. So where are the areas of risk on an income producing property? And that could be anything from the leases, the tenants, the creditworthiness of the tenants, length of the leases, the physical property and the condition of the property, and is there any deferred maintenance or likely capital improvements or other things that might need to be made? What about market conditions, occupancy, vacancy, what direction are rents going? The borrower themselves, the experience, etc. Political changes, that could be changes in tax rates, it could be changes in zoning in a particular area. So in underwriting or evaluating the property or evaluating the potentiality for a loan, you have to think like a lender. What are the risks? So in looking at the borrower or investor, the lender might look at their experience. If the investor is looking to secure a loan to purchase a retail shopping center, a retail strip center, the lender is going to want to know what experience does this investor have owning and operating retail shopping centers. If they have extensive experience and they own a lot of shopping centers, well, that certainly reduces the risk from the lender's perspective. This investor knows how to operate this particular type of property. On the other hand, if the borrower, the investor, doesn't have experience in operating this type of property, that's going to be a risk factor for the lender. Do they own other commercial properties, other types of commercial properties? That might mitigate some of the risk associated with the fact that they might not have owned this particular type of property before. Is there more than one investor? Is it a group of investors? Is it a partnership? If so, can we get personal guarantees not only from the primary borrower, let's say if it's a single investor, but if there's multiple partners, can the lender get personal guarantees from all of the partners? Obviously, what is the investor's financial resources? Are they a wealthy individual? What kind of capital resources do they have? If they need to pull money from one of their other investments or from their private or just from capital they may have on hand in order to pay costs associated with owning the property, do they have the capability of doing that? Do they have cash reserves in other areas to be able to pay that? Is cross-collateralization possible? That is, if they own other properties, can we secure the loan on this property by having as collateral one of the other properties, one of the other, let's say, more valuable or one of the other properties that has a greater amount of equity in it? They also want to look at what the investor's plans are for the property. Are you planning on is it a stabilized property where nothing much needs to be done, just need to own it and operate it? Is it a property that has some deferred maintenance? Is the property going to be redeveloped? What about the tenants and the leasing plans? What about management, property management? Are you going to be doing the management yourself or hiring a property management firm? And who is that property management firm? And do they have experience in managing this type of property? So one of the things that the investor is going to look at, as well as the lender, is the rent roll. Now, I mentioned rent roll in a previous lesson, but this is a rent roll from a shopping center. And what a lender and an investor is going to look at are the different tenants, the type of business the tenants are in, their credit worthiness. They will particularly be interested in when the leases expire. So if the leases are coming up in the near future, how is that tenant doing? How likely is the tenant to renew? Typically, and as I mentioned in a previous lesson, for a retail tenant, the more successful the retail tenant is in a particular location, the less likely they are to move. Are there bumps in the rent along the way in the existing leases? Is there a flat rent or are there bumps? And then operating expenses. Is the tenant passing through 100% of the operating expenses? Is there a cap on how much the tenant has to reimburse the landlord in terms of expenses? All of this impacts cash flow, which impacts net operating income, which of course impacts the investor's ability to pay the annual debt service. So these are all things that the lender is concerned with. So just in summary, with respect to the lender, the loan, and the willingness to provide a loan, the underwriting of the property, underwriting is not just one thing. It's a multi-tiered evaluation of the investor, the experience of the investor, the property type, the condition of the property, the market, all factors that might impact the ability of this property to generate sufficient income in order to pay the loan. So there are risks associated with every situation, every property. If there are risks, are there ways that the lender can mitigate those risks? Maybe have the borrower, investor set aside some money in an account with the bank for unforeseen situations that might arise. That might be a requirement of the loan. And just like different investors will evaluate different properties differently based on their experience and their preferences, so will lenders. Lenders definitely have preferences and more experience with one type of property than another. And they will typically tend to always go or specialize in that particular property type. Now, some lenders and larger lenders, of course, may lend on multiple different types of properties and may even have specialists within the lending institution who specialize in shopping center properties and somebody else multifamily properties and what have you. But lending plays a significant part in almost every commercial real estate investment. And as we'll see in our next lesson, can have a big impact also on the return to the investor.